I did mention before the break this software stock cut. Price cuts across the board. Atlassian, Snowflake, Datadog, Sumo Logic, Elastic, Cloudflare, Smartsheet, Asana, Varonis, CrowdStrike, SentinelOne, Workday, and Zuora. So it's been across the board. Jim, you own Salesforce and Microsoft. The new Microsoft target is 325 from 400.
Okay, still a nice gain from here. And, you know, those two stocks you mentioned, Microsoft and Salesforce, they have earnings, and they don't have ridiculous multiples on those earnings. A lot of those other names are trading on sales and still, in my opinion, too high multiples on those sales. So, look, I'm not overexposed in software, and the ones I have are the high quality. To this analyst report, I say to myself, well, you know, you're doing this now, a year after this debacle has begun. Where were you back then? I really am comfortable with Microsoft and Salesforce. Those other names, I wouldn't touch them.
Sarat, Microsoft is the only one really on this list I think you have, right?
Yeah, and I agree with Jim wholeheartedly. I mean, you look at all the divisions Microsoft has, their multiples come down, strong cash flow. And if you look at kind of what's going to happen over the next couple of quarters, I mean, they're going to be sitting there with increased cash flow. They can buy back more shares. They can increase their dividends, or they can actually, you know, reinvest back in the business. So for Microsoft, this is a great opportunity for investors like us, because some of their competitors now, you know, are trading at 7-8 times sales, and who knows if the earnings ever come. So if you're competing against them, it's an easy way to go to your competitors and say, hey, are you sure you want to be with some of these companies? Because look at us, and we're going to be around for a long time.
Joe, are these targets? They make sense. I mean, Microsoft's at 261. So the new price target's 325. I mean, clearly it represents the new world that we're in. The question is, are estimates and targets still too high?
No, I think estimates are coming down correctly. The big challenge for all these software companies, and I think collectively why everyone who sits on the desk has really advocated steering away from higher valuation software names, is the cost of capital is still a moving target. And long duration assets, which exactly these businesses are long duration assets, except in the case of a name like Microsoft, which is, you know, has that free cash flow generation right in front of it here and now. But that revenue generation, if the cost of capital is a moving target and you have to fund your operations, you don't know what that cost ultimately is going to be. And that's why I don't think you could step out right now and accept the risk in a lot of these software names. You have to be very conservative and judicious, stay high up in quality, low valuations, and be respective to what's the debt levels on these companies.
I'm looking, you know, for example, Sarat, Microsoft, the PE is 27. Does it deserve to be at 27 in this kind of a market?
Well, if you look at the growth rate of the S&P, which over time is 6 to 7%, and Microsoft's double that, you should definitely be trading at a much better premium than the S&P. And at 26 for a cash flow company that is increasing cash flow over the years, is a proven track record. Absolutely. I think, you know, does 26 go down if the overall market comes down? Yes, but with double-digit growth and a strong increasing dividend, I think Microsoft deserves a premium. The question is, you know, the market falls down to 35, 3,700, multiples compress, but longer term, a lot more comfort in holding a Microsoft than holding some of these stocks that might never have
I'm sorry, but I guess my point is the market multiple has already come down. There are a lot of stocks that some would make the argument haven't come down close enough to a market multiple, or if they deserve a premium to the market multiple, they're still too high. It's not a matter of if.
So, no, but Microsoft's traded over 35 times. It's also come down to 26. So I think it's come down, but you pay an extra premium for growth that the market can't give you, and that's what the promise Microsoft has, is it's a higher growth and more, you know, less volatile growth than some of the other growthier names.
Yeah. Bryn, growth at a reasonable price is how people would talk about stocks like this. The question is it a reasonable price for the amount of growth you're likely to get over the next, I don't know, 12 months minimum?
So when I look at the NASDAQ, and if you look at the NASDAQ multiple on a forward earnings, so let's just make the assumption that the collective NASDAQ makes those said earnings, has come down from 33 to it's almost 20 today. So the forward multiple on the NASDAQ 100 is 20. And so, which is average. Average only going back to like 2006, though. And so I do think, though, because we're in this different type of environment, that the multiple of Microsoft could easily come down, because it's not what multiple we should or shouldn't pay, it's what multiple the market wants you to pay for it. So I own Microsoft, it's a long-term holding, but I am totally open to the idea that at 27, that could easily need to come down when the NASDAQ itself is at 20 on a forward basis.
That's what I'm talking about.
Yeah.
That's exactly what I'm talking about. Jim?
Yeah, I think it's a valid point. It's why I'm way underweight Microsoft. I have about a 3% position in it, but I want you to consider something. What does that mean the weighting in the S&P 500 is? It is 6%. I'm not an ETF buyer, Scott. You heard me say pick stocks before. But the truth of the matter is, as the market goes up, part of that is going to be people buying spiders. And QQQs, where I think it's 10%, Microsoft is going to participate in any rally. But I'm underweight it for exactly the reason you're saying.